Hi, everyone. My name is Don Fallenbaum. I'm a CPA. I've been in practice, looking up at my walls since 1997. So I guess approaching 25 years. I've been doing this a long time. And I do specialize in the real estate space, helping realtors, real estate brokerage offices, as well as real estate investors. And I'm also there as a resource for a lot of my realtor clients in helping their clients if they have any tax issues or structuring any deals if it comes to investment type properties. So with that said, when we get started, there should be some really good information and you should really enjoy today's talk. I'm going to start off talking about having the right business structure for your real estate business. And then I'm going to hand it over to Chris, and then he's going to take it to the next step and talk about having the right financial structure. Once you start making some nice money and you can start investing and saving for retirement. So we're going to start off
Hey, Don.
Yep.
Sorry to interrupt. Before you get started, can Chris introduce himself and then we'll send it back over to you? Perfect. Okay. Thanks. Chris, the floor is yours.
All right. Well, welcome, guys. I want to thank you guys for attending the event. Some of you may have heard me speak before about different financial subjects, but I'm super excited about today and kind of having this dual approach where we're helping your corporate structure set up, and then we're helping with some of the benefits after. Now, my side of the business is more on those benefits side, setting up the 401ks and growing our assets to another level, or maybe on the insurance side to protecting some of the things we thought we needed. Been in the business for about a decade, certified financial planner, RICP, CHFC. Hopefully we can provide some information to you or just at least one or two aha moments. And if you need anything from us, I was able to speak to Don earlier today. We're both open to you guys reaching out to us and asking either one question or 100 questions to make sure you guys are in a better scenario tomorrow than you are today.
Okay, so why don't we get started? We're going to try to make taxes sort of fun. I know it's not the most fun thing to talk about in the world, but unfortunately we all have our silent partner and sometimes not so silent partner, Uncle Sam. So by default, so you have your real estate license and you're starting your business, and that's great. The association is a great resource for all of you on the real estate operations side. However, you also have the business and the accounting and the tax side of your business. And that's where someone like me comes in. So by default, without doing anything, you're all independent contractors and you receive a 1099, which is reported on a Schedule C on your personal tax return. Schedule C is a business form where you report any type of business activity. That is by default. That's if you don't do a thing, but not doing any, and that's the easiest, obviously, because you don't have to do anything, any kind of structure. But it's not always the best structure for you. Okay. Number one, when you're reporting a Schedule C, that net income, whatever the net income is subject to what's called self-employment tax. Self-employment tax is an extra 15.3% tax on top of whatever your regular tax bracket is. What self-employment tax in effect is payroll tax. Okay. The other negative aspect of having a Schedule C is that for those of you who don't keep the best records, which I know none of you do that, every item on every line item, it comes under the scrutiny of the IRS. Okay. Also, for those of you that like to get a little bit more aggressive with your expenses, such as mileage and so on, and maybe some marketing costs, which I'm sure no one here does that as well. Again, that gives you a little more scrutiny. Okay. The next level up would be, and everyone seems to be running to Sunbiz and forming LLCs. That may or may not be the best thing for you. Okay. By default, when you set up when you go on Sunbiz and spend the $70, whatever it is, if you do it yourself, and now you're an LLC. Okay, so what do I do now? I'm an LLC. I heard this is like the best thing since sliced bread. Well, an LLC, by default, a single member LLC, which all of you will be because you're the only ones in your entity, okay, is what's called a disregarded entity with the IRS, okay? And what is a disregarded entity? That means that it basically does not exist as far as your IRS is concerned. You may have your EIN number, you have the name set up, whatever your name is, comma, LLC, and now you're ready to go. You have an LLC, I'm ready to do business. Okay, well, it's not gonna do anything for you, okay? Number one, as a disregarded entity, it's still reported on the same Schedule C, and the same tax regime, everything's the same. The only thing you may get is maybe a little bit of extra liability protection having the LLC. If you get sued, a creditor or someone suing you can only attach business assets that you have under the name of the LLC. However, if you don't do everything exactly right, and if you commingle any of your personal and business assets, if you don't keep your annual reports, if you don't do your annual meetings, a good attorney will do what's called piercing the corporate veil. And basically they're going to deem your LLC entity as what's called an alter ego of yourself. So like it doesn't exist. I'm not saying it's going to happen, but that's the risk you take having a single member LLC. So it may give you some liability protection. It gives you no tax benefits. Okay. The next step up, and you could elect to have your LLC taxed as an S corp. Okay. And that'll bring me to the next step up. So everyone has heard about PAs, and I'm sure some of you have a PA. What is a PA? Basically, a PA stands for a professional association. And what that is basically is a corporation. So again, you're going to go on Sunbiz. Instead of going LLC now, you're going to set up a for-profit corporation. And you're going to call it whatever your name is. And that's another thing that I see a lot of headaches is that when you set up either a PA or an LLC, it's got to be exactly the way your license certificate is with the DBPR, okay? If it's not exact, when you go after you have the entity set up, when you go to the DBPR to change the name, if it's not exactly the same, even with or without a middle initial, they will kick it back and then it becomes a big hassle. You're gonna have to do a name change with the state, then you're gonna have to change it with the IRS because it's associated with EIN number. It's a big hassle. So knowing that little thing, just that little thing right there is having the right, make sure you have the right name when you set it up. If you're doing it yourself, very, very, very important, okay? So I got a little bit off tangent, but I just want to make that point right there. So you go online, assuming you do it yourself, you go on Sunbiz, you set up a PA now. Now by default, okay, by default, you are a C Corp, okay? Now what is a C Corp? A C Corp basically is a separate legal and taxable entity with its own tax rates. Right now, the maximum tax rate is 21%, okay? Now, unless you do the proper filing to elect to be an S Corp, you are going to be a C Corp. And that's another area of mistakes I see all the time. Now, why don't you want to be a C Corp? Well, with the C Corp, because it's the corporation itself, the entity is taxed at that entity level, okay? The corporation itself is going to be paying tax, whatever the income is at 21%. And then when you take money out of the business, out of your entity, you're going to pay tax again in the form of dividend income. So that's where you get that double taxation. And you might have heard that before, C Corps have double taxation. That's where that comes from, okay? I don't like single taxation, so you guys don't need to be paying double taxation, okay? So that said, the next step, once you go to Sunbiz and you file your PA, and now you're ready to go, I have my PA, let's do business. Well, no, you have to apply to become an S Corp. There's a form you need to do for that. And that's not electronic. You have to actually print the form out, sign it, and mail it into the IRS, and then they will send you back a letter with the approval. Okay, that generally needs to be done within 75 days of the date that you actually set up the corporation. However, there are ways around that for late elections, and I'm not going to get into that right now with 20 minutes. I have to watch my time also. So I could talk about this for hours. Okay, so now let's say you did the S Corp election. Okay, now you're an S Corp. What is that? An S Corp basically is the same legal structure as a C Corp. They're both corporations. The difference is the way it is taxed, okay? As an S Corp, there's no tax at the entity level. So the corporation is not going to pay any tax. What happens is the net income or loss now flows through to your personal income tax return and becomes part of your personal income tax return. If you have a net income, that adds to your other income. If you have other sources of income, if you have a loss, that will reduce your overall taxable income. Okay, so and that comes through on what's called a Form K-1 from the S corporation. Now, the advantage of the S corp versus the single member LLC, or just a straight 1099 independent contractor, which is basically the same thing. But the advantage of that is that net profit now that comes through from the K-1 from the S corp is not subject to that self-employment tax, that extra 15%. And that's a big source of tax savings, okay? Now, you might ask yourself, so how do I take money out of an S corp? And that brings me to another issue. It all sounds great, but like everything else, there's a catch, okay? And I'm gonna tell you about that catch. I'm gonna use a quick example to illustrate it. It's a little bit of a difficult concept, but with an S corp, because the corporation itself does not pay tax and everything is taxed at the corporate level at the end of the year, you're allowed to take out what's called distributions, which in effect is an advance against that tax that you're gonna pay at the end of the year on the K-1, which is not taxable at the time because you're paying the tax at the end of the year anyways. That's called a distribution, okay? So let's assume you had 100,000 in gross commissions, you had about 50,000 of expenses, so now your net income is 50,000. If that was a 1099 in a Schedule C, you're going to be paying whatever your tax bracket is, plus an extra 15.3% tax on that 50,000. Okay. Same thing with the single member LLC disregard entity. Now with the S corp, what's going to happen? That 50,000 is going to flow into your personal return, and it's only going to be subject to whatever your tax bracket is. But here's the catch. Okay. As an S corp, as an owner, employee of an S corp, you're supposed to pay yourself what's called reasonable compensation for services provided to that entity. Okay, it doesn't exist by itself. Someone is providing services who is generating the revenue for that entity, for that S corp, for that PA, and that someone is you. So you're supposed to pay yourself what's called reasonable compensation. You can take it all out in the form of distributions and not pay any self-employment tax or payroll tax. It's the same thing. And how do you determine reasonable compensation? Well, it depends on a lot. There's a lot of factors involved. I've used kind of like as a guideline over the last 20 or so years as about 50-50, 50% payroll to 50% distributions. So on that same example of 50,000 of net income, throughout the year, you would show about 25,000 of payroll, actual payroll, taxes taken out, W-2 at the end of the year, that becomes part of your personal income, 25,000, and then the other 25,000, it comes on the K-1, so it's split, and that satisfies the IRS, okay? So in effect, what you're doing now is you're cutting that self-employment tax or that payroll tax in half, because you're only paying it on the payroll portion of it, okay? And the higher the income, the more significant tax savings you're gonna get from that. So it's very important, I see it all the time. S corps, whether it's for a realtor or PA or just a straight S corp, just showing $100,000 of net profit, all distributions K-1, and no W-2 income. It's a problem because that's a big hotspot with the IRS. Okay, so with that said, now the other advantage, I said that with the Schedule C, all your line items, all your marketing costs and your auto expense and your entertainment and your meals, all that is subject to scrutiny. When you're set up as a separate entity on an S corp, all that gets filed on a separate tax return called an 1120S. Okay, and the only number that ends up on your personal return is that net amount, that net amount on the K-1. So all the line items, all your various expense items, none of that shows up in your personal return, and the chances of a small corporation being audited versus a Schedule C on a personal return is much, much, much less. So that's where the intangible benefit of having the S corp or the PA set up is the reduction of the IRS audit, and that's a big thing. Okay, so that's another big advantage of setting up the S corp, as well as the tax advantage of that. Now, certain things that I see all the time that that I like to bring up to you that are issues. Number one, I touched upon the name of the entity. Very important to have the right name. Number two, if you set up a PA, you need to make sure just going on IRS online and getting your EIN number and pushing it and selecting it's going to be an S corp does not make you an S corp. Okay, you have to send in the form 2553. So I see all the time someone thinks they're an S corp, but they're really not. Okay, as a matter of fact, I just had an appointment just a half an hour before this class, and I had the same situation. Had the S corp set up. Actually, it was an LLC set up. That should not have been an LLC to start with. And there's kind of creative ways around that to convert it to an S corp, even 2 years out, as long as no tax returns have been filed. That's a different class. But yeah, there's certain things that you could help yourself and do it right to start with, that it'll eliminate the headaches down the road. And one of the things could be, hire a professional to help you in the beginning. That way you don't have any issues that come up down the road that you're not expecting. And whatever the professional charges, whether it's me or whoever, it's well worth it. Well worth it. I'm not gonna, if I have plumbing issues in my house, I'm not gonna do it myself and have a flood in my kitchen. I'm gonna hire someone that does it right. It'll be done half the time it'll take me to do it, and I won't have to wear my bathing suit in my kitchen. So the same thing with this, except this has a lot more implications, because this is in your pocketbook. Okay. Now, another thing I just wanted to bring up, a couple of quick tax changes. You may have heard, starting in 2021 and 2022 for 2 years, it's a temporary provision where in the past only 50% of meals can be deducted. Starting in 2021 and 2022, you can deduct 100%. Okay, so that's a big deal. And again, if you have it on the S corp, less of a chance of being audited. Again, I don't know how aggressive you are, but keep records. The better records you have, even if you get audited, it doesn't matter, because you have the backup to it. But that's a big change. Another big change is that for some of you who are starting off, and I know it takes time to build up your pipeline. You start developing some listings and developing some buyers, some rentals in between, but it takes a little bit of time. You may have some large losses initially. Those losses now, starting in 2019 and 20 and 21 with the new CARES Act, allows you to actually carry it back to 5 prior years, and you could offset your taxable income going back 5 years when you might have had some taxable income to get some money, to basically amend the return to get money back. So that's a big thing, and a lot of people don't know about. So that was part of the CARES Act. So I would definitely keep that in mind as well. With that said, I mean that pretty much in about 20 minutes, I can't get into really a lot more detail than that, but I wanted to give you a good overview, some things to look out for, the differences basically of a Schedule C versus a single member LLC, and then the S corp, and certain points to look out for to cause you or to alleviate possible headaches down the road, which will alleviate headaches for me down the road because I'm the one usually has to clean it all up and fix it and make it good for you guys. I'm the one that stays up all night worried about all this stuff, so you don't have to. My focus is to take care of all this fun stuff, all the tax stuff and the accounting and endless deadlines, so you can go about building your business and focusing on that, so you don't need to worry about that. Let me stay up all night worrying about it, so you don't have to. That's what I pay. That's what I get paid for. So with that said, so at this point, you have your business structure set up. You're starting to make some money. Hopefully, I don't mind paying taxes, okay? Because if you're paying taxes, that means you're making money. There's nothing wrong with paying taxes. The idea is to pay the minimal amount, the least amount that you legally have to. And by having the right structure, we could do that. But now that you're making some money, and especially with the way the market is on fire right now, and you have a lot of listings, and you do an open house, and that weekend you have 10 offers above listing price, and deciding who's going to get it, which are great problems to have as a realtor. But now that you're making money, what do I do now? Now I need to start taking the next step, and how do I use qualified plans to try to, again, minimize the tax burden, and at the same time saving for your retirement, so you have something put away for later on, and you start building up your financial structure. And that's where Chris is going to come in to help you take the next level. And now that you're making some money, you have the right structure. Now I need to build out my financial structure. So again, it further limits your taxes and minimizes it. And now you're building your financial structure for today and for tomorrow. So Chris, hand it off to you now.
Thank you, man. Thank you. Kevin, do you want to say anything? I saw you pop up. I didn't know. Cool.
Good deal.
Go ahead. Cool. Well, I want to thank you, Don. So I had the pleasure of speaking to Don a little bit earlier today, and then the pleasure of hearing him right now. And I can't tell you how important it is to have a CPA who knows what they're doing when it comes to business structures. So I work with a lot of clients who are getting ready to retire or have made a lot of money. And it all comes crashing down if they don't have the right protection or the right business structures in place. The thing I want to make sure that caught my eye, what you said, Don, is when you said, but there's a catch. And what I don't do taxes, but what I've always found out is there's always a catch. The IRS is a catch to everything. So, you know, for those of you who just jumped into the real estate business and you were, let's say, a W-2 employee your whole life, taxes were relatively easy, right? You did through TurboTax, you called it a day. Now that you're a business owner, you're owning assets, you're having income that sometimes is very great and sometimes is not. I would highly recommend at least interviewing a CPA like Don to make sure that you have the things done right that you should be. So super important point. Oh, as far as my side of the business. So my side of the business has a little bit more of, let's see how fast we could grow our assets and let's see how long they're going to last, basically. All right, so my side is on the finance side. So you'll hear me or talk to me about a lot of things when it comes to retirement accounts, 401ks, stock market, bonds, things of that nature. And then on the protection side would be some of the insurance side. But let's kind of ballpark this and see why we're doing this. So I don't know how many people in this class have been in real estate for a long time or not, but there was a time when the markets were hot before, like 2004, 5, 6, and 7. And what everyone did in real estate is buy more real estate, buy more real estate. Well, what has turned around since then is we know that, hey, if all our eggs in one basket, we better make sure that basket is great or foolproof, or let's just have things in different baskets. So I say that because I find it more now than ever before that I have a lot of realtors saying, hey, you know what? I am owning a couple pieces of real estate. I'm going to flip some. I'm going to sell some. I'm going to rent some. But I want to make sure it's not in one asset. So how can I effectively and efficiently make sure I have different buckets of money for different time frames? That's really where I come in. So what we want to do is we want to make sure, one, our financial picture is organized. Right? So everyone who's on this call right now can do this by themselves. Basically, what you want to find out is, hey, what's income do you need to survive if you just started, right? Because your income is going to be up and down. What income do you want to make? Then what's your expenses? How much assets do you have? How much do you owe? How much debt do you have? And what kind of contracts do you have in place? Wills, trusts, things of that nature. So you want to make sure you have that down because that's going to be your foundation of how are you going to grow into the future. Don mentioned something about a plumber and having professionals do the job. Well, no different than a plumber needs to diagnose a problem or we need to diagnose a problem. But you can never find out what that problem is unless we have it down on paper. All right, if you can't find where the leak is, the plumber can't do the job. So our first job is to find out where are we today. And then our next job is to find out where we want to be tomorrow. So where we want to be tomorrow is maybe we want to own 10 pieces of real estate that we're getting rental income from. We want to have $1 million invested in the market in the most tax efficient way. We want to be able to maybe travel a little more, do all these other things. Whatever your picture is your picture. Well, my job is to get you from what that piece of paper says to what you want that piece of paper to say. Now, Don started talking a little bit about qualified retirement accounts. For those of you who have been part of an organization before this, company, non-for-profit, whatever the case might be, you might have had a retirement account there. 401k, 403b, IRAs, things of this nature. Well, now that you talk to Don, you set up an S corp or whatever the corporate structure he thinks you should for you and your practice. Now you're going to set up those retirement accounts. You're going to set up the 401k or something of that nature. Now this allows you not only to take tax deductions, but also fill that bucket of money you want invested in the most tax efficient way possible. So if your goal is to, let's say, retire in 10 years, 15 years, whatever the case might be, and you're making a lot of money this year, you want to make sure that you're going to be efficient with that. And I'm going to explain what I mean. I have a lot of realtors as clients, or let's say this 1099, income's high one month, income's low the other month, or income's really high one year, not so much the other. Well, and Don can contest this, what that does is it really screws with your tax code. Right? Every single year, we start at the same tax rate. I don't care if you make $1 million or if you make $10, and that tax rate is 0. But as you make more money that year, your tax rate goes up. So one of the techniques we use is we take retirement accounts like 401ks, and the years we have those great high years, we could shove a lot of money in there and lower some of our taxable income. So we don't have to give the IRS as much that. And then the years that income is lower, given some age requirements, which we'll get into, you can use that money, let's say in retirement, where your taxes are lower. Now, because this has something to do a little bit with taxes, there are some limitations you can. I'm not going to get into too much of the limitations because it's super individualized in which retirement account you would have. So if you sat down with Don, you set up the corporate structure, you decide, hey, I want to sit down with Chris next, make sure my finances are set up correctly. We may decide for you to set up a 401k or a simple IRA or a SEP or something of these natures. And they all have different rules. The one thing I want you to understand is there's no limitation to saving. The IRS, Social Security Administration, all those companies want you to save. There may be different loopholes you got to go through to get there, but they want you to save for your future. So just keep that in mind. So we have this, we have this idea of, okay, we're setting up this retirement account, we're setting up this 401k, we put it away. Now, what do we do? What kind of money does it make? How do we take it out? How does it work? And I bring that up because a lot of times I'll hear this question. Okay, I want to set up an IRA. I want to set up a 401k. What interest am I going to make? And I want everyone to understand that when it comes to setting up these retirement accounts, it's not an investment. It's just a bucket. So if you decided, hey, I want to set up a 401k for my company, for my S corporation, and you decide I'm going to put 10, 15, 20, whatever $1,000 in there, that doesn't mean that investment is going to do anything. It's just a basket, just a bucket. Our job, though, is to add the investments that will make this bucket grow. So when we sit down or when we talk, we're going to say, okay, what is our goal, right? What is that picture we want to see? And that's going to justify what kind of investments we're going to put into that account. So if you're somebody who, let's say, is young or super aggressive or need to play a little catch up, we're going to use riskier investments that have a higher potential, but there are some risk. Think of like your growth stocks. If anyone has looked at the stock market throughout this year, the companies that have made the money in the first quarter was your growth stocks, your risky growth stocks. Next quarter is a little, the second quarter's been a little different, but we could get into market updates later. So we have this set up, right? We're saving money into our 401k. We're investing it. We're growing this piece of our financial puzzle. We're diversifying our assets. Well, as we diversify our assets, we definitely got to talk about protecting ourselves also. Right? We're all business owners now. We're all entrepreneurs. So we have to provide our own benefits. We have to provide our own value for us. We don't have a company that's going to give us health insurance, life insurance, disability insurance, and like I said, these retirement benefits. But there's a reason why companies offer those. Right? Some of the biggest issues that anyone finds out, or the biggest financial shocks that they have in their life, are due to something that could have been protected. God forbid, if someone got COVID and had to go to the hospital, their health insurance would cover that. For someone who didn't have that, it was a different story. Their assets had to. So how do we provide benefits that we're used to a company providing is basically another arm of our financial picture. Right? Do we need health insurance? What advantages do we have for it? Or some more of the questions I have is, hey, I want to make sure that if I'm sick and hurt, I'm still getting some kind of income in. I'm sure some of the people here have heard of Aflac and seen the commercials. But you guys are in a position or in a job where you're driving around different places. God forbid you couldn't work for 2 months because of a car accident. What income are you going to get from that? And is there a benefit to help with that? And the answer is yes. Most people have it at work. But remember, mind you, you are your own work. right? You have an employer hat and an employee hat. So as an employer hat, let's make sure the employees are taken care of. So continuing that process, should we set up something like that? Or should we have our company offer our employees, which is us, some other benefits like life insurance? Those two are probably the most common ones I get. Now, we all have a different concept of how life insurance should work. And you're going to hear people in my business, outside my business, talk about permanent policies or term policies. I'll be honest with you. Depending on who you are, depends on what you should have. And I'm not here to tell you one is better than the other because it's all individualized. Some people should definitely have that term insurance, which term insurance is basically insurance that has a ending date. Think of renting a house. At a certain date, that lease is up. And you either got to get a new lease or get out of the house. But in the meantime, while that lease is I guess, active, you do have a roof over your head in the form of life insurance. And then you have permanent, which is like owning that home. Chances are you're paying a little bit more probably. You got to make sure things are doing right for you, but you can own it for as long as you want. Keep it as long as you want. You can sell it. Take lines of credit on it, basically. So there's different insurances for different people. Don't let any person tell you this one is better than this one, or this one's better than this one, because it's all about what's better for you. So on my time, I wanted to give a high level view right there, and I'm going to break some more down for it. If anyone has any questions, though, about some of those high level and which ones they want rather me break down first, go ahead and shoot or put something in the chat, and we'll make sure we hit on them. That being said, let's break down more of our investments, more of our retirement accounts. So when it comes to some more of our retirement accounts or some of our investments, I told you, or I started talking about how it's going to go into a basket. Everything's going to flow into a basket. From that basket, we have to create what kind of investments should we have? Or you just want to go on the side and create some of your investments on your own, don't care about the retirement account, just want to. How do we really start? What companies should we buy? What investments should we count on? So if we are starting an investment, let's say portfolio, or we're trying to grow that part of our asset accumulation arm, what we're going to want to do is build our investments like we would build a house. We're going to start with the foundation. And when it comes to the foundation, it's probably the most boring part of a house. Nobody talks about a foundation unless the foundation's bad, I feel like. But we want to start that same way with investments because we want something that's solid, we could count on, and we can, with consistency, know we're going to create some kind of return over some kind of period. There's a couple rules we want to follow when it comes to the foundation. First rule is diversification. Right? Don't put all your eggs in one basket. It's probably the only certainty we have in the investment world of lowering risk without lowering return. So if we want to diversify, the next question is going to be, well, how do we diversify? Right? I only have $5,000, $10,000, or whatever the case might be. How am I going to buy all these companies and still have enough to buy all these other companies to help with this diversification? And the good thing is the industry has started this. Right? 100 years ago, they created a thing called a mutual fund. A mutual fund, basically, everyone threw their money into a pot, and that pot had enough to buy enough stuff to be diversified. Right? As technology and years of age, we got other things. We got index funds. Index funds focused on, hey, let's actually just own everything or a particular sector and never change that sector. Just take the cost out of it and allow that foundation just to have some kind of growth, but no kind of change. And now one of our biggest bucket, let's call it investments, are called ETFs. And you're going to see ETFs for everything. Now, they were designed to really replace mutual funds. I'm not saying they do, but they were designed for that. Their job is to be a lower cost than their mutual fund counterpart, be able to give you more flexibility, but still have the same value. And that value is diversification. So what we would do is we're creating this foundation. First rule, diversification. What we would probably want to do is own a bunch of ETFs in different areas, right? Instead of buying Apple, Google, Microsoft, let's own a technology ETF. And we can maybe buy all those companies for a fraction of the price. And now, okay, great, we have our tech ETF. Now maybe we need a consumer staples, our Walmarts, our our Targets, our things that our Home Depots, our consumer staple investments. We can have another basket. So you can see we're owning these baskets to create this foundation. So the next rule we want to follow is quality of investment. What I mean by quality of investment, I don't mean the individual shares, right? Apple or Google or things of that nature. What I mean is that actual basket. So the best thing about the internet, best thing about the way life is now is we have access to everything. And when I say we, I mean all of us. I don't just mean me as a professional, I mean all of us. And the good thing about that is there's a lot of competition. So if we have these different baskets, let's say technology basket, consumer staples baskets, fixed income baskets, things of this nature, we don't have to have the same company. And I'm going to tell you the truth. One company doesn't do the best at all of it. So when we look at quality of investment, we want to see what basket from its competitors are best or doing best currently. Third one, cost. Now, when it comes to cost, all else being the same, less is better than more. But all else may not be the same. So, that's why quality of investment comes before cost of investment. But if we find two investments that are the same quality, cost can play to determine which one we should be in. And the last one, and the most interesting one, is timing the market. I know everybody here has heard the saying, you can't time the market, and they're right. I don't know if Apple's going to come out with a better earnings or Google's going to come out with a better earnings or something of that nature. But we can tell trends in the market. We can make expectations because of our large trends. A few months ago, everyone thought that there was going to be some inflation from all the money pumped in. Well, you can make adjustments based on that and have a higher chance of success to see some of the inflation that we did see or something of that nature. I bring that up because those are our 4 rules we're going to follow. If we follow those 4 rules, our foundation is going to be strong. Now, once you have this foundation strong, you might be someone who says, you know what, I like this diversification, strong foundational approach. I want to just keep building on it. I keep building the stronger financial or foundational approach to investing. Or if you want to play a little bit or have a little bit more fun, you should build some walls on this. Build a roof, put some fixtures, buy some investments that have a higher opportunity for growth, but God forbid something did happen, you still have that foundation. So congratulations, in 7 minutes, I just gave you the secret to every single financial planner's business, period. Don't get off the phone right now, but that's basically our secret. So we have this set up on the investment side. Now, again, we're still being a little bit vague, both Don and I, because it's super personalized, unfortunately. I wish I could tell everyone the secrets to the soup, and it's the same for everybody. I could tell you how to make the soup, but I can't tell you the ingredients until we're in talking individually. We have that. So does anyone have any questions so far about anything we spoke about? Cool. Perfect. So I know I have a couple more minutes to stay on this 20-minute time frame, so we have some questions, so I'll make sure I do that. The one thing I want to make sure I cover, because remember, this is a general conversation. This is a general conversation about how you should be structured and how you should build your financial picture into the future. Don talked about corporate structure. I talked a little bit about investing and insurances. The last thing I want to literally finish up on is wills and trusts. So one of the common mistakes I see in people's financial picture is not having the correct will or trust or something of that nature to protect all the things they built. Now, I don't care if you're 21 years old and you got 100 years left in your life, or you're 85 years old and you're just looking to enjoy the last couple of minutes. They're super important for all of us. When we think of a trust, think of it as a safety deposit box that you get to create. And instead of giving people the key to open the safety deposit box, you're just writing the instructions of how you think someone should be able to take this money out. Now, if they can follow those instructions, they can reach in there and use the money, God forbid something was to happen. The value that adds is, hey, we're here in South Florida. If you do have any kids and they may have a spouse, you don't want that your money to go to that spouse. God forbid there was a divorce. Have that safety deposit box. Or you're buying a lot of real estate. You're owning a lot of rental income. I know Don has ways to protect you on the LLCs and the S corps, but let's say somehow someone sneaks through and tries to sue you personally. Well, the money in that trust is not going to be able to be accessible, or going to be harder to accessible. Attorneys have an amazing way to figure out stuff, but it'd be very hard to target. That's what I want to touch on. Is there any questions? I think I have 9 seconds left of my 20 minutes. Cool. So let me finish with one thing. So I wanted to talk a little bit about something Don and I were talking about this morning. And what we came to conclusion is we both have a lot of clients who have been a little bit lost when it comes to how they should set stuff up. And I'll be honest with you, it took us decades to learn the information we know, and it's very hard to translate this information within a 20-minute segment. So what we're probably going to do, if we get enough requests, Don and I will probably set up a series, maybe it's 3 to 5 classes, where we're going to go into detail on explaining how you set up corporate structures, how you set up retirement accounts and your benefits, all that kind of stuff. If it is something you feel like you want more than a crash course and you want a full length of understanding this, let Kevin know, let Liz know, let some of your people know who are part of the Miami Realtors Association, so they can relate to us and we can make sure we come up with that series for you guys. Cool. Any questions? I see a couple people have some questions on wills and trusts. If you want to reach out to me private, I gave my number and contact information right there. Go ahead and send me an email. I'll make sure we schedule a time. But I do see one question here. What % do you suggest for investments from your income? Super loaded question. You're going to hear people in my industry say many different things, but there's a couple factors I want you to consider first. One, how long do you have till you need that money? And do you have to play catch up? You might be in a scenario where you want this money, let's say in 10 years, and you need $2 million or something like that, but you haven't started. Well, you may need a significant more of your income than if you're somebody who, let's say, has 40 years till they want to use it and still needs that same $2 million. But where I'm getting at is every dollar you put away to your investment is going to be good for you in the future, but you can't answer what percentage till you know a little bit more. And I want to leave you with this question. I want to leave you with this statement for that question is, we know every dollar you put away today is a sacrifice to enjoy that today. If you put $10,000 this year for your retirement, you can't go on that vacation with that $10,000, right? You made that sacrifice. So when you decide what % of your income are you taking, you're saying, okay, what sacrifices can I make today for success tomorrow? And that will help determine what percentage we're going to need. Hey, Don, I see you had a couple questions on the chat. I don't know if you want to pull it up and answer some of those.
Yeah.
For instance, benefit.
Sure. Yeah, there's one question. Do you have to use a payroll company? The answer is no. You don't need to use a payroll company. You can use a payroll company. You could use your CPA to do it, or you could try doing it yourself. The problem with doing it yourself is you need to make sure that you do the proper forms correctly. Quarterly, there's a 941, there's an RT6, which is a Florida unemployment. At the end of the year, there's some additional forms. But the point I want to make to that question is not so much who's doing it, but if you use a payroll company, yeah, you're going to tell them how much payroll you have and they're going to do it and everything will be done compliantly and it'll be fine. What you're not going to get with a payroll company is you're not going to get the advice and the guidance, okay? When I work with a client and I do their payroll, as well as being there as their advisor throughout the year and not just at the end of the year, is that we look at their numbers on a quarterly basis, okay? Payroll reports are due the month after the end of each quarter. So for example, right now we're in the second quarter, April, May, and June. The next payroll reports will be due in July. What I will do is get together with my clients sometime the first part in July and say, okay, what was your gross sales? What's your net? How much you've taken out in distributions? Based on that, we will decide, or I'll recommend how much payroll to do in that quarter. So I did it very simplified earlier as far as the 50-50, 50 payroll to 50 distributions. But as we all know, your income is not always the same each month and each day and each quarter. It varies. So what I typically do is do it quarter by quarter to make sure you're paying enough in payroll, but not too much so you pay more, so you're not paying more payroll tax than you need to. So it's that balance, okay? And then if we do that each quarter by the end of the year, everything should be in line and you should be at roughly that 50-50 mark. So that's the point I want to make about the payroll company. More important than who's doing it. Obviously, it has to be done right, or you're going to have additional penalties, which no one wants penalties. But that's the point about that is knowing how much payroll to do and having that guidance. Okay. There's another question: the benefit of an S corp over single member LLC. I see that was at 112 right at the beginning before I did the presentation, so I'm sure I answered that already. Lot of benefits. Anybody else have any other questions? I actually do want to make couple other points. Having the entity set up is not the end of the process. Once you have it all set up, then you have to contact the DBPR and you need to give them the new name and get it registered. And then you need to contact your broker and give the broker the new name. Well, actually, they'll look it up in DBPR and you have to give them the EIN number, because I've seen it again. I'm trying to help you avoid these mistakes and these headaches down the road. You don't know how many times, come the end of the year, a new client, oh, you have an S corp, you have PA said, oh yeah, it's all set up, it's all ready to go, and then they get their 1099 and it's made out to them to their social security number. So having that entity set up, but not taking that one or two extra steps, it's an issue. Okay. Again, there's creative ways around it, which I do. Okay. But we shouldn't have to do that if it's done properly. So those are a couple of points I want to bring up as well. Anybody else have any questions? Either unmute yourself or write it in the chat, whichever you feel more comfortable. Or down the road, feel free to reach out to me anytime. I believe Kevin will be forwarding both our information. No? Come on, this is fun stuff. Where's all the questions? All right. Chris, do you have anything else you want to add to it or bring up?
No, I was good with some of my comments. I mean, really, like I said, the biggest downside to any kind of general conversation like this is, unfortunately, there's nothing general about anything we do. It's like, if you had 30 clients to buy a house and you said, hey, you should look for this kind of house. Well, honestly, if you don't know what that person is, who they are, what they like, or what they want out of the house, it's going to be really hard to do that. That's the same concept here. All right. So our general mission in this conversation is really just give you a baseline of information. Right? What are some of the things you should look out for? What are some of the things you should avoid? And give you a stepping stool of where you should go. So I know.
I guess there's a couple other questions there. Yeah. Let's see. Someone has an S corp PA, and he was advised that he can't deduct depreciation because it's not in his name. No, I mean, if you're using it for business purposes, and again, you should keep track of your mileage. So the mileage on an entity is not, you're not deducting a mileage rate, but the purpose of keeping track of your mileage is so that we could show the business percentage of use of the vehicle. But no, it doesn't need to be in your name. You can still depreciate it. Do it all the time. It's kind of splitting hairs. As a matter of fact, you may end up paying more insurance if it's commercial insurance versus non-commercial. So no, it doesn't have to be in your name. How you move back to an LLC from an S corp? Yeah, you could do that, but I don't know why you would want to do that. Sometimes it's better actually just forming another entity. And the thing is, there's no reason why you can have more than one entity. I mean, you could have your PA for your real estate business, and if you're also investing in real estate, if you're developing a portfolio of rentals, you could have an LLC structure for your rentals, which sometimes is not necessarily to be an S corp. You can keep that as a single member LLC. But depending on how far you want to go with asset protection, you take it to an nth degree with asset protection and have combination of LLCs and S corps as members of a portfolio. So it's all, I mean, it depends on what level you want to take as far as asset protection. But no, you don't really want to move back to an LLC from an S corp. I wouldn't advise that. I don't see why you want to do that. And there was one other question, I think it was further up. Let me see. Yeah, that has a PLLC set up and currently elected as an S corp for chosen LLC S corp for flexibility to elect LLC and S corp on 415 or any advantages. Okay, first of all, for the S corp status is not 415. It needs to be done by March 15th of the current year in order to be effective that year. And the question is currently elected to be an S corp. But once you're elected to be an S corp, then you really don't have that flexibility because you're already an S corp. But you really need to get with your advisor when you're setting it up, and just based on your income projections, what you expect your net tax to be, or your net income to be, kind of set it up initially instead of going back and changing it. I think I answered that question. So again, anybody else have any questions, feel free to reach out to me either by email or call my office. I guess that's it. And it's real, and this is a great comment. This is actually the concept of this course is actually great because it's going from the mechanism of creating the income and creating the net worth to then growing it and helping and letting that work for you. You're going to work for it and then let your net worth work for you at that point with the least amount of tax and the best buckets, based on your goals and your objectives going forward. So does that sound about right, Chris?
Sounds like I said it myself.
Okay.
Well, gentlemen, thank you so much for hosting this class. Based off the meeting we had earlier, it sounds like this series will be expanded into more topics. If anybody wants to learn about a certain topic, based off what they learned today, let us know. I'll be sending the class out and their contact information. So all of us together can create a curriculum that is catered to your needs based off what you provide us. So don't be shy. Let us know what you want to learn. And we hope to bring you more fantastic content later on this year.
Yeah, but on my way home, yeah. Wouldn't it be crazy? But you still amaze me.